Contrasting Viewpoints with Ray Sclafani and Mark Hurley.
Ray has been one of the leading consultants in the financial services industry for many years, and Mark has annoyed countless people throughout the wealth management industry over the last 25 years with the white papers he has written. Today, they are going to provide their insights into what is really going on in the industry, some of the more absurd things they've seen, and also for anyone in this industry, some issues they should be thinking about as they try to build their business.
Hey, Mark, great to be back with you once again.
Great to be with you too, Ray.
Okay, and the feedback is everybody is really hot on your microphone. They love your new sound.
Well, that's good to hear.
And today we're talking about technology. So that Shure microphone, SM7B or 78, that's the one that's working for you.
Which is not a sponsor of our program.
Okay, very good. All right, terrific. Well, let's get into today's topic, which is deep in the world of technology. Let me start with an article out of wealthmanagement.com. The actual AI usage across the advisory world seems to be expanding. Almost 36% of advisors reported using ChatGPT in the latest T3 Tech survey. We're going to talk about Joel Berkenstein later today. 68% of advisors reported using some type of AI technology in Orion's recent study. And in the Advisor 360 survey, just 8% of advisors believe AI to be a threat to the profession. And so there is a whole lot of sea change happening in the world of tech.
Yeah, it's a great article. It looks at a couple of different surveys that are out there. Orion did one. It was relatively small. It was about 585 advisors. There's also a survey about 300 done by Advisor 360. But my advice to any listener would be, you should always have a healthy dose of skepticism when a technology company does a survey, because they clearly have some agenda built in. That said, they have a lot of information that seems to be consistent. What is striking to me, which was noticed, and we'll talk more about this with Joel's stuff, is all the existing apps that people are using are now getting AI extensions, and people are learning how to use them. That seems to be the really big AI adoption, as opposed to real game changers. The only thing that was different was this new company called Jump that has captured about 8% of market share very quickly, that has an AI for transcription services that seems to be very, very well received by advisors.
Yeah, in fact, in February, Jump announced a $20 million Series A funding led by Battery Ventures, bringing the total capital raised to close to $25 million. And just this week, they announced it's becoming Osaic's, formerly Advisor Group, official technology vendor. So it's clear they're tapping into some of the larger independent and hybrid firms as well.
Yeah, it's a better version of transcribing meetings and notes is the way they describe it. In other words, you know, when you get Zoom, they have a transcription part of that. But this one is allegedly a more sophisticated way that you can assign tasks, does better follow-up. It helps you be more organized is how they're pitching it.
That's great. Okay, let's move on to the second article that got both our attentions this past month, M&A Outsiders by Dan Moisand at a Financial Advisor magazine. He writes, when you run an advisory firm, sometimes people show up who want to work for you. Sometimes these are people fresh out of college who want to learn planning in a certain way. Sometimes they're career changers who get caught the planning bug late in life and want to be joiners. But lately, he sees another trend. People who fled other advisory firms that have been bought out and who don't like their jobs anymore. He calls them M&A refugees. This is something I've not heard before, but he sees the numbers growing, and he points out that this is on the rise. And in McKinsey's latest study, in a shortage of roughly 100,000 advisors, this article you wrote about a year ago, Welcome to the Jungle, sharp elbows in the jungle when you're looking for talent. And if PE firms are aggressively moving into M&A land, these M&A refugees can be a great source of new talent for advisors.
Well, this is also the single greatest job employment act for attorneys. And we're already seeing, waves of litigation involved. The challenge in ever buying a wealth management firm is there's really no tangible assets. It's simply the goodwill that you have with existing clients. And the other dilemma you have is generally the people selling out are the people who are the older people, the ones who actually have generated clients over time. But you're buying effectively the successors. And as these firms are being forcibly integrated into each other, what you're seeing increasingly is a lot of people saying, I'd rather work somewhere else. And it's one thing if, I got paid $10 million when the firm was sold, and okay, I'm happy I made a lot of money. If you're someone else who just got a fraction of that and you're a young person and you got your career ahead of you, a lot of them are deciding they don't want to work at these bigger firms. Now, this firm, to their credit, I thought this was a very clever article because they're a $1 billion firm based in Melbourne, Florida, and intentionally is effectively putting out "We're here to hire you if you're looking for a job" sign. It was really smart guys who did this because they recognize there's a lot of talent to be grabbed. But if I'm a buyer of one of these firms, we're going to start to see more and more of the talent start to migrate. And the whole notion historically has been, well, we'll rely on restrictive covenants. Just sue everybody, sue everybody, sue everybody. And that works to a point. But it's not I can game any non-compete. It's not that challenging.
Yeah, the non-compete, non-solicit is not the gaming of the system.
Yeah, and for example, most firms don't meet with the clients but once a year. It takes 2 years for a client to even realize somebody's left. And by then, the non-compete's expired. And a lot of states are hostile to this. So I think this is a part of a much broader trend that if someone's going to buy a firm, they're going to have to rethink the financial incentives. It just can't be about the founders, quite candidly. And there's so many buyers now, they're paying the founders mind-numbing multiples to buy the businesses. There's an additional cost, which is how do you create the right program to keep the talent behind them? And one of the things that we'll talk about in future calls is how do you develop that talent? Because most of that talent, quite candidly, is very good at servicing clients, but lacks the ability to bring clients in also.
Well, I've got a point of view on that. That may be true, that last piece on bringing new clients in. But one of the things I see pretty consistently is when firms become more effective institutional lead generators, whether that's through one of these programs like Fidelity's WASP program or the Schwab referral program. That's an institutional lead generation machine. When firms build their market specialization, which I think you talk a lot about, they get known in a particular community group, they generate a lot of leads.
Yeah.
Most advisors are good at closing and winning business.
Yeah, but let's understand too. First off, as I like to say, if you're relying on programs like WAS or Schwab's referral programs, to quote a friend of mine who used to run one of the biggest money managers in the country, they're analogous to cocaine. They may feel good, but don't get addicted. It will kill you because they actually control the economics and who can participate in those programs. The real solution for wealth management firms is to have people who can develop their own center of influence networks and can actually go out and start bringing the clients through the door. Now, the guys at WEG, who are brilliant, Jeff Deco, his guys,
Yeah,
are
the Wealth Enhancement Group. Yep.
Yeah, and same thing. Merit has done this. Mission has done this. Pure has done this. They are so good at building a brand and doing marketing at the institutional level that a lot of times they do acquisitions is simply to get bodies to service the clients. But most of the other firms, no, the brands, they've not done that kind of stuff. And where that's been most successful, quite candidly, has been with the emerging affluent. It's not been with the semi-affluent, the $2 million and above type client, which everybody wants to try and get. So the challenge, of course, is you buy a firm, you get a lot of talent in the firm that's helping hang on to the clients, and you worry if they leave, could the clients follow them, which is a real risk. But also, how do you get them to actually convert from simply servicing to actually bringing clients in? Or do you spend a king's ransom marketing? Schwab is the only firm, I would argue, that really has a nationwide brand. That's because they spend $585 million a year. And Schwab and Fidelity, I imagine, also because they spend similar amounts on marketing. And nobody can afford that. So you've got to find a way to develop talent.
I'm with you on the developing talent piece, but I think you're missing my point. My point, these M&A refugees are it's the first time I've ever heard anybody talk about these M&A refugees, which I kind of think is interesting. Now I got to dig in.
I've heard bubbling on the surface. I'm hearing stories of this all the time.
Yeah. So a lot of these talented professionals are sitting in these firms as leaders in the firm and may not be great lead generators on their own, but may be great at closing and winning business when somebody else generates the lead.
That's right. That's right. I'm not saying their talent it's valuable talent. The only thing that surprises me about the article is it's almost like saying, here's a flashing, we're hiring, come see us, we're hiring.
Yeah.
But if I'm a private equity firm, I'm going, we're suing.
Right.
So it should be a little entertaining for them.
Okay, so good. So we can maybe talk about organic growth strategies. I still think the industry has got a miss here in looking at the role of an advisor who also has to be a business developer. And the sooner that firms focus on new client acquisition strategies that are institutionalized at the firm level and generate leads and build specialization, I don't think it's a fortune to do marketing. The cost of acquisition and the lifetime value of clients, when you look at the numbers, this is the greatest business in the world to invest in marketing and building a specialization.
This is the greatest. I mean, imagine a business where I'm going to pay you more over time to do less. What a great business.
Let's move on to the next article out of CityWire in the RIA channel. There was an interesting CEO summit and a new development published last week. The inaugural CityWire CEO summit, Ian Winnick and CityWire founder and chairman Lawrence Lever had a wide-ranging discussion with three top RIA executives: Focus Partners Wealth CEO Adam Birnbaum, Merit Financial Advisors President Kaylin Mayhew, and Cerity Partners Head of Partner Development Claire O'Keefe. And this is the first in a series of 5 videos where Winnick and Lever ask these executives how their roles have changed. This is kind of a departure of needing to go to a conference and watch a panel. This content's up on CityWire. Actually, it's a really interesting set of interviews.
Yeah, this is Ian Winnick, who is one of the smartest media guys in this industry besides Evan Simonoff. And what Ian has done is he's made it so that you can get the same quality of information you would as if you spent $1,000 to fly across the country and sit in an auditorium and watch people speak. The only thing is you can't ask your own questions, but they got some very talented people in that are sharing different ideas. And I think that you're going to see more of these types of things done because you can get some of the top people in the industry actually giving a lot of information, being asked by, being questioned by people like Ian, who's a brutally tough journalist, to give ideas and insights you couldn't get on your own.
I would add to anybody listening to this podcast, this episode, check out citywire.com and look for these interviews. My take was that each of these executives did an outstanding job talking about the evolution of their firm and how their roles may be changing. And it's worth a really important listen.
Definitely.
Okay, let's go on to the next article, which is really an interesting threat for many independent advisory firms. The Investment News published an article, FINRA moves to bar ex-Wells Fargo employee charged with identity theft. Now, I know with your cybersecurity firm, you're paying lots of attention to these issues, but this is a wake-up call for firms to look at cyber and the threat in different ways. This gentleman, Calvin Gray, repeatedly impersonated victims who were customers of a number of other banks and financial institutions, according to the federal indictment. And so this is something worth paying attention to if you're an independent broker-dealer or RIA.
Everybody talks about outsiders coming in and stealing stuff. This was an insider attack. And the new SEC proposed rules require that you protect against this. But if I can steal a client's non-public personal information, I can sell it for $1,000 per client. Or I can use it myself to go try and steal their identity, which is a $54 billion annual industry, which is used primarily to steal credit. So think about this. You have a wealth management firm. You got some administrative employee. And this guy was not working with clients. He was just an administrative employee. And keep in mind, Wells Fargo has layer upon layer upon layer of
the protections
controls.
And the security and controls.
Yeah, and
right.
This guy got around those controls. So if you're running your wealth management business and your receptionist, for example, can access all of your client information, you are begging for trouble. One of the core things you have to do when you set up your systems is make a decision as to who can see what information and who can download what information. And it's got to be on the basis of a need to use and a basis of a need to know. I know we all want to trust each other, et cetera, but as your business gets larger, the statistical likelihood of having an outlier do this goes up. Now think about this. Imagine having to pick the phone up and call your clients and say, hey, I got really bad news. One of my employees stole your information and proceeded to use it to steal your credit. I mean, how many clients do you think you're going to have after that's over, especially when that hits the news? Oh, and there's also this thing called Reg SP, and you should expect an enforcement action from the SEC like the next day when that happens. So
it's not hard to get this information,
business,
totally. And selling it on the dark web is not difficult.
Yeah, and understand, this can happen to Wells. This can happen to anybody.
Absolutely. Okay, that's a good pay attention to. risk to the business. Okay, our favorite part of the episode before we get into our main topic around tech, you've got to be kidding me. There is an article out of RIA Biz by Oysen Breen, and this is just unbelievable. Ellevest impresses analysts and enrages some women by firing 99% of its investors with a late evening email, by keeping its 287 more profitable accounts and shunting 72,000 uneconomical ones to Betterment. The New York City startup future looks brighter, but a money coach's letter says, "You've slapped us all in the face. You shut us up and shut us out." Ellevest spent 10 years getting women to believe it was one financial firm they could trust. They gave them about 40 days to clear out. This is not quite how it's being reported. Mark, what's your take on this?
Yeah, I mean, all right, come on. First off, I wish someone at RIA Biz would take a course in economics. It'd probably help their reporting quality a smidge, all right? All these businesses are scale businesses, and the reporting here kind of ignores the reality unless you dig way deep into the article. What happened was the company got to a certain size. Like any business, they made a decision that certain clients they just can't make money on because they don't have the scale. So rather than abandoning them or dumping them or whatever baloney they put in this article, they went to Betterment and they cut a deal so that most of them will pay lower fees. And then they gave the client the option of saying, hey, we can't support you anymore simply because the economics don't work for us. But we've cut this great deal with Betterment. You don't have to go over there. We can send you your money back. But we wanted to make sure you were taken care of. And instead they put a quote from someone saying, "You've turned your back on the very women you purported to champion." Okay, now we're back to everything's got to be a 15 on a scale of 1 to 10. Company gets to a certain size, it doesn't get the scale. It takes steps to protect the clients, and then it moves on to a more rational economic model. If anything, the management there should be applauded.
All right, good. So let's move on to our main topic, technology, and what technology are wealth managers using. T3, Joel Bruckenstein had its latest T3 conference in Dallas just last week. And there's a couple of really interesting statistics coming out of this very comprehensive and long life study. It's been published for many, many years. And what jumped out at me were a few key trends, notably some of the trends among AI and what's happening. Now, I know there's a buzz about AI, but we're seeing all these technology organizations fuel some part of their tech stack and layering in parts of AI. That seems to be jumping out at me. Additionally, we're seeing some of the firms sort of start to decline in terms of using some CRM tools in different ways. I thought that was a standout to me. But this is the first year we've seen the survey data increase in terms of quality substantially. In fact, in the T3 study, it's notable 15% of firms generating $8 million or more in revenue, and 11% of survey respondents generating revenues between 4 and 8 million. So you've got more than 600 firms generating more than 4 million revenue. These are real firms. This is not typical lifestyle practice, small firms, dabbling in tech. These are real firms looking at their tech stack and doing different ways. And there's some real key standouts in the study.
Yeah, everyone should get a copy of this if you're in this industry, if you're a CEO or you're a technologist. Both should get a copy of the study. Joel and Bob Veras did an incredibly good job. It's done on an anonymous basis. It's 2,100 firms, so it's a large sample.
A big sample size.
And 70% of them are fee only, so they're capturing a lot of the larger firms, which typically are the biggest firms, but there are also many hybrids included too. And the participants do it anonymously. In other words, they don't have to worry about being besieged by vendors trying to get their business, and therefore they're far more willing to share information. And they do a very good, overlay layer of trying to analyze generally what's going on. What I thought was fascinating to me was sort of how the whole industry is shifting on a couple of different points. They also even get so far into the weeds as talking about who is thinking about adding or changing custodians. For example, they found 14% of the Schwab-affiliated firms in the poll, which is, I think, about half the firms total were Schwab, are thinking about changing or adding another custodian, about 11.5% of Fidelity, and 18.5% of Pershing. which shows you kind of an interesting dynamic. And I don't think necessarily they're going to replace them. I think they may add a second one.
Most firms are multi-custodian anyway.
That's right. It's this continued trend along those lines. Now, the most striking thing to me, and obviously I have a parochial interest here, is only 21% of the participants are basically doing anything about cybersecurity.
Okay,
now,
let me just stop you right there, because you do have a dog in this hunt.
do I ever?
But as an objective sort of outsider who doesn't, this is astonishing to me. Everybody knows the SEC's got regs changing coming up here in the imminent future. And the fact that 21% of firms aren't doing anything, are the only ones doing anything with cyber. And that means a third of that is largely employee training.
Yeah, before.
This is like a massive opportunity, and perhaps the greatest threat that these advisors face in running their wealth and management business.
Yeah, there's also advisor armor, which is largely applets that sort of let you know you've been breached and maybe do some pen testing. They don't prevent you from getting breached. And when you take all of that out, it's like a de minimis group. Now, to be sure, Joel, when he was up on the stage, got up and said, well, maybe their local IT provider's doing something that's not showing up in here. And there could be a little bit of that. But let's keep in mind, if you're using your local IT provider, I like to compare that for your cybersecurity. That's analogous to getting your podiatrist to do eye surgery.
That's an awful
It's not going to end well, because you need people who actually know what they're doing. I mean, and you think about this these are a lot of large firms are included here too. I mean, you're talking about the poll. The survey has over 300 firms with more than $800 million, 15%. All right. Well, that suggests to me that some of those aren't doing anything materially about cybersecurity. My view is that this is going to be the big shock when it comes. When the rules that were proposed last year and the can got kicked down the road, at some point there's going to be a major breach. And that major breach is going to get headlines, and the SEC is going to finally be forced to get off the schneid and do something. Or I just think later this year, once all the drama and the political stuff has started to calm down, they'll get back to doing the regular stuff. And the rules they proposed are very non-controversial. The other thing that jumped out at me from the survey, if I can move on, is Advizon seems to be really the
gaining
latest,
share.
hottest thing in the space other than Jump.
Yep.
It's an all-in-one firm. About 5% of the entire survey participants were interested in were considering shifting to that platform, which I find is very unusual because advisors move at the speed of a glacier when it comes to this kind of stuff.
So I'll tell you, one of the other standouts for me which was really surprising, was that software for digital marketing lead capture is only 21%. That's down from 29% 3 years ago. And software for digital marketing content, it's only 19%. What are advisors thinking? The greatest wealth transfers coming right at them, the need to retain next generation and clients, and the need to build out their platform of specialization and branding and marketing for their firms. Why are firms not paying closer attention?
Yeah, and I agree with part of that and disagree with part of that. One, I always am skeptical about lead capture, just because leads have never been really the way most firms have gotten billed. It's been referrals. And it's very, very different. And lead capture is really intending to go out and just try to find anybody you can cold call and say, hey, I saw you do this.
That's not lead capture. You're totally off base. Lead capture is you're getting traffic to your website.
Okay.
You're using social media. You're using PR and getting placed. And somebody's clicking on some good quality piece of content because, man, you're the specialist in working with,
I understand that, but it's the follow-up and capturing of those it's a much lower percentage than referrals. If someone makes a referral to me, I got a much higher probability.
That's fine, but when
client.
you become large enough in scope and size, you can't just rely solely on referrals.
I agree with that. When you're getting to real numbers, then it's different. You have to have all different ways of attacking.
My argument is I don't think advisors have really looked ahead, further enough ahead. I mean, why do you think there's $1 to $2 trillion of private equity coming into this marketplace?
Oh, yeah.
Yes, the fee on AUM, the recurring revenue, the subscription revenue, I call it. But the reality is the greatest opportunity for growth sits in front of us in the next 10 to 15 years.
Yeah, and this reflects that too, in a sense that it's like, have you ever seen the National Geographic video and the fish are going by and the bear is just opening its mouth and grabbing them as they go by? There are so many potential new client opportunities that you're right. Many of these firms, and these exclude some of the some very savvy firms. You know, you think of some of these guys that are like Shannon Yusi's firm at Beacon Point is growing 13% organic every year because they're using everything they can do to get clients.
Right.
But other firms are kind of like the lazy bear that's sitting there with the mouth open. As the fish goes by, they go ahead and grab it.
Well, that's my point. My point is if I'm looking at this digital marketing, content management, and lead capture, this is a chance for firms to be leaning into this and paying more attention. So I don't know. That's a standout for me. I think the other one was the largest increase usage in estate planning software in the last 2 years has increased usage by 27%. So second is
tax. Getting old.
And they're needing the help. And the second is nobody wants to pay more taxes. Tax planning software, number 2, increased by 11%. So we're seeing advisors. This points to the expansion of wealth management as a service. And it's not just managing clients' money, it's the expansion of other services and increasing wallet share in new and different ways.
Yeah. On the AI side, you know, we're seeing that ChatGPT is kind of the core thing that people use. About a third of people who use AI stuff, which about 42% of the industry say they're using some form of AI right now, in the survey that is. And about a third of those are using ChatGPT, and then Microsoft Copilot's kind of in second place. About 5% of firms in general are using that. What I thought also was interesting, though, there's about 11% are now using AI for graphics. In other words, they're upping their game and finding ways to do far more better ways of communicating using AI software in their graphics.
Yeah, and we're only going to see this increase over time. Mark, we're going to have to leave it there, unfortunately. And thanks for getting together today and having this conversation.
Thank you.
We will put the survey results from Joel Bruckenstein's T3 survey in the show notes. And thanks for listening, everybody.